Good morning, good evening, wherever you happen to be at this moment. I am A.F. Thornton. I am the Chief Investment Strategist for Blueprint Quantitative Strategies. And this is our 7/22/2022 version of Morning Notes. Cutting it the night before, I will add any Globex updates in the morning, but I am trying to move these to the afternoon so I can spend a little more time on them and not be so rushed every morning to get to the trading room, etc. So let me start with the usual precatory language. Where do we have that there? Obviously, we are not your financial advisor. This channel is strictly for educational purposes. It's not meant to be investment advice or any kind of investment recommendation. We're simply doing our best to show you what we do and how we do it in the hopes that you can learn to trade as well. And of course, as always, I remind you that our channel is new and we need all the help we can get. Slowly but surely, we're building some members and building a community here. We've only been at this for a couple of weeks. Even though I've been doing this for 35 years, we are new to YouTube and I'm learning a lot. So just help me through it. And give us a like if you could. Share the video with your friends. Try to pass this information along. I think it's great information. There's nobody doing this like we do. There's just nothing out there, and I see it all. So pass this along if you like it. Give us a like. Consider joining the channel and signing up for the notifications so you know when these are going to come out. So you can also find a lot of information over at blueprinttrading.com or blueprintquantitative.com. Just remember there's no E in Blueprint. And our email address is info@blueprinttrading.com. So with that all out of the way, let's just jump into it here, because it's always nice to see your forecast come to fruition. So I can summarize it very, very quickly here by just saying that, actually, let me flip to the daily chart briefly. Basically, all of this was a falling wedge, which we felt was a one wave down. Now, there is an alternate opinion. I mean, this could be an ABC correction, but for the most part, just, if you go to the thesis on our blog, I lay it out there in a lot of detail. I think we are in a generational bear that it's probably going to last until early 2023, and I'll show you that in a minute. So I don't think we're done yet, but what I have pointed out is, having completed that, what I call a leading diagonal, first wave down, we completed it here on the 40-week cycle low on June 17th. And we've been advising everybody that that would be an important low. Not that we didn't have our doubts a few times, but for the most part, we have been, I guess my exact words were, I'm slightly bullish on that low. I think I gave it like a 50.5% probability. And maybe that's all we ever get in this day and age. But in any event, I did believe that to be an important low. And comparing it even to other, well, if this were a cyclical bear market, we're 6 months along. We've corrected 25%, a lot more in other indexes and stocks. So if this is a cyclical bear, this could be the low. And that remains a possibility. I'm not going to exclude it. Always try, I think the hardest thing in this business is to keep and, have an opinion of sorts, but not be married to it, and be flexible and trying to keep an open mind and get past confirmation bias. So that's something that, you want to be able to do if you can. But in any event, that's been our forecast. And now we see that coming to fruition. So, however, the granular level here is important, but let's step back a minute and look at the bigger picture. And I want to go to a monthly chart And I want to start with our monthly profile because this is really the roadmap that we're on. And it tells you a lot about where we're headed and where we've been. All of these high volume at price nodes, this is the volume, for example, here at 4180. This is the volume at 3905. Remember, this is the hill we've been trying to climb since that June 17th low, and we've managed to finally get over it. So these high volume nodes are areas of resistance or hurdles, no matter what direction you go. And then as we drop into the lower volume nodes, the market can either turn there, again, providing resistance, or sometimes we'll climb the next hill. Now, what are these hills? Because I marked them for you. These hills are essentially a complete auction from low to low, low to low, and low to low. So these are the long-term auctions we've been in, and you can see the micro auctions that go below that, and we'll get into micro options on the 1 minute chart. But in any event, the task since June 17th has been to get over this hill, which is around 39.10, and over the past few sessions, we've now gotten over it. We've come down the other side, and we've gotten into this flat low volume node here, which I call a rocket pocket. It's an air pocket. There's not a lot of volume in here, so there's not a lot to stop the market from flying through that level. And that's what it did today. We were about halfway through the level until the close, and there's about $1.5 billion share order imbalance that kind of tipped us up at the end. Now, having said that, we gapped down in Globex tonight. So as of this recording, we're at 35.86, which is right in the middle of this low volume node. So what the market has to do is it has to decide, does it want to continue climbing? We have our next small bump here at around 40.70. We get into another low volume node, and then we've got another hill to climb all the way up to 41.80. So that's the task at hand for the market now. Otherwise, we're going to head the other direction, and we'll see what happens again at 39.10. And we can do both. We can come back and retest this 39.10 level, or, and keep going down. Now, when we were in this zone, I kept saying to you, we've got sort of a rocket pocket if we go this way. We've got one if we go this way. But fortunately, the market has been very, very oversold. So we're getting this pop up. And the precedence for that is pretty strong. I mean, in most of the bear markets, if you study them, going back, over the last, really since the Great Depression, you'll see that in about the 6th month of the bear, you'll usually get a relatively larger retracement back up that lasts usually a month or two. So, and not that it goes straight up or anything, I mean, it backs and fills, but you do see kind of a positive bias for a couple of months, and then we roll over again. And of course, that would be well timed with the usual, July to August rally, and then rolling over again in September. So, there's lots of considerations here. I mean, we have finished the strongest part, of the market in the year is usually in early July. So definitely some positives here. But I have to tell you, I mean, I do see, first of all, there's a ton of cash on the sidelines, ton of cash. And FOMO doesn't take long to kick in, especially with professional money managers who have to report to their clients every quarter. So there's plenty of money out there to fuel a rally. But of course, there are many, many dark clouds on the horizon as well. So we have to keep that in mind. So basically, as of this writing, actually the purple line there is where the market is right now at this moment. Okay. So we have to, if we're going to go back up through here, we've got a little resistance at 40.70, and then the next major resistance at 41.80. So that's the task going north and coming south. We've already been here, maybe a retest of 39.10. Now, the other thing I'll mention, we'll go over it a little bit, is we are at the top of the weekly expected move. So I don't know how much more we can get out of this thing in the next 24 hours. Whatever's going to happen will probably start next week. So keep that in mind as well. We'll look at that here in a minute. Now, it may not be useful to you to know, well, we might go north and, we'll bump into some resistance here, or we'll bump into some resistance there. I mean, how does that help you? Well, first of all, I think knowing where those key levels are is very important. But second, I monitor the auction in a real, market is a continuous auction. And I monitor that auction in real time. And that's how I can tell if we're either pushing away from these resistance levels or we're managing to overcome them, because the volume will taper off if we're unable to get much further. So it's to me, it's like reading chart music. It's not that tough. So that's how you know in real time what's going to happen. But if you have this roadmap in the top of your mind, I think it helps a lot. So the back to the monthly chart though, and that's my surprise for you. So I'm going to take that off real quick. But let's kind of go down the line here and look at where we're at. Obviously, we've been correcting now for 1, 2, 3, 4, 5, 6 months on the S&P 500. Like I said, you usually get a little reprieve. And here's a perfect example in the 2009 bear market, 2008 to 2009. Came down for 6 months, and we had these two months of reprieve before we rolled over and things got even worse. So there is a great example just sitting right there of what I'm talking about. Now, I said enjoy the long vacation because Armageddon and the Great Reset will soon cut it short. Kind of a play on words. You have a chance to be long here for a little bit, but it's not going to last. So let's run down the list here and just kind of take a look at what's happening. And let's go back to our channels and roadmap. So if you go back and read the thesis on the website, what you're going to see is my thesis is that, this is just the largest version, the generational version of regression to the mean. And in that setting, we will typically come back to the mid of the 100-year channel. We've only been up here 3 times in history. This is a 2 sigma move up the channel, and we did that in 2000, we did that in 1929, and then here in 2022. So this whole Fed-induced and Fed rally is, brought us to some exceptionally high levels, and we're now correcting that. So in typical fashion, we should go to the mean, and the mean is somewhere around 2,600 right now. Kind of cuts through the middle of that old expanding triangle that we messed around with from 2017 to 2019. So that's, somewhere in that range. But in the meantime, where are we now? All we've done is come down to the middle of the 2009 bull market channel that you can see here in blue, right? So, this is nothing. I mean, this is nothing. This channel is roughly 40%, okay? From the top of the 100-year channel to the bottom. And if you divide it in two, it's about 20% on each side, right? So, this, and I'm talking, by the way, I'm not the 100-year channel. I'm talking about the bull market channel, the 2009 bull. So the blue channel here is 20% in the upper half and 20% in the lower half. So our 20% correction just brought us to half channel. To go to the bottom of that channel, it's another 20%. And to go to the 100-year channel, you're probably talking about a 50% top to bottom correction. Very typical for a bear market, and certainly for a generational bear market. So that, I'm sticking with that thesis until proven otherwise. And I think that's probably, something to just keep in the background. If the market wants to just bottom here and continue on, and this is just, a larger than life correction, well, so be it. I mean, we'll go with it. I never try to argue with the market, but this is our general thesis, so keep that in mind. And let me just show you that if we were to look back on that monthly chart, this is the highest volume node in the neighborhood since, these COVID lows. So this 2727, depending on when we get here, does kind of coincide with these projections to mid-channel on the 100-year channel. So that's another thing I just keep in mind, that, like I said, those high volume nodes can catch you. They provide a lot of resistance. So I'm looking at that, as a potential target. But for now, let's stick with the program. But I do think you have to ask yourself, is a mid-channel 2009 channel enough of a correction based on everything we see going on out there? And I don't think it is. I think we're just getting that usual temporary reprieve based on the 9-month cycle. It's going to give us some tailwinds for a month or two at the most, and then we're going to roll over again. Now, the other thing I want you to do, and we'll expand on this in a minute, but I think it would be safe to use the June monthly candle as kind of a breakout candle, right? Use that as a breakout range. Obviously, if we break below that candle, the bear is resuming and we're going to go lower. If we break above it, especially materially, then it could make this look possibly more like a cyclical bear low, more of a 20-25%er, and possibly we could go in and form a trend range. I mean, there's all kinds of possibilities. Remember, these are monthly bars, so they take a long time to form, but that's definitely something I'm looking at. I'll use the June candle as a breakout range. And by the way, every candle is a breakout range. I don't care if it's a 1-minute candle or a 5-minute candle or, a daily candle. So I look at them that way. Now, let me add the moving averages that matter to us here. And we're going to look at those a couple different ways. But let's get some of the other stuff off. Let's go ahead and take the channels off. Let's see, where did I put? I try to stay really organized over here, and I encourage you to do the same. When you can flip right to the things that matter to you, it helps tremendously in not getting lost. I still get lost, but, do my best. All right, so anyway, there's all your key moving averages from the monthly chart. And I want to point out a couple of things to you. The ones that really matter on the monthly chart are the 5 and the 21, which are, the 5 is kind of your short-term trend, moving average. And then the 21 is your longer-term mean. Kind of the mean for the 2009 bull market would be a good way to look at that. And what I want you to notice is that the moving averages are crossing right now. So the 5 is coming below the 21, and the 21 has turned red. So the 21 is pointing down. On a monthly chart, it takes a while to get that to happen. And of course, the 5-month average is pointing down. So that's, again, a little bit bearish, certainly not dispositive, but definitely bearish. And that's why I pointed to a bunch of these, because moving averages tend to kiss and then resume more often than they cross, especially on a monthly chart. So, you can see here, even on the COVID crash, the moving averages kissed and then the 5 moved higher. They kissed again here in 2018. They kissed again here in 2016. But if you go back to the bear market in 2000, really it lasted from 2007 to 2009, you can see that they actually crossed. So, the question is, this is what a cyclical bear looks like. They kiss, but this is what a secular bear longer. And by the way, cyclical bear is something that's usually measured in months, and a secular bear, generational bear, is measured usually in years. It lasts a while. Like this was, almost 2 years. The 2000 bear was 3 years, and I'll show you where this one might end up here in a minute. So, just because they're crossing isn't the end of the world, but again, more often than not, they kiss. So I guess you want to give a little bit more credence to a kiss than a cross. Even as bad as things seem right now, they may not end up being as bad as, we think. I mean, when you're at the bottom, even in a cyclical bear, things look terrible. So that's not anything new. So, but let's look at the other more important thing that I really wanted to cover today in the title of this video before we get into all the stuff we need to watch for tomorrow. And that is the cycles. That's not the cycles. There they are. All right. So, a lot of people have a lot of respect for. You can talk to people like Martin Armstrong, who I've followed for 20 years. And of course, I definitely incorporate her cycles not only into my work, but our algorithms. But here's your her cycle stack here. We're basically at the midpoint of the 54-month cycle, which last bottomed at the COVID lows. We're in our second 18-month cycle, and there's usually 3 of them in the 54-month, and we're past the midpoint of that. And so the only thing working for us right now, and even giving us some tailwinds here, is the 9-month cycle, which is the most important cycle we encounter in most of our swing trading and intermediate trading. Now these are the names of the cycle. I think of it as a nominal 40-week cycle. It's averaging about 35, 36 weeks. So try not to, cycles aren't that precise. And so this is just the name of the cycle because it's usually approximately 9 months or approximately 40 weeks. But these cycles, do vary a little bit. It's called the principle of variance. But in any event, I think that is what we bottomed. So we've got that working for us, but we're going to have all of these other cycles working against us. And when you look at the backdrop of the economics of everything, you can see why this could be the Armageddon cycle that brings us the Great Reset. The economic situation in the world and the change that's occurring is very, very disruptive and is certainly causing a lot of the problems that we're experiencing. And again, people have a lot of respect for that run true, accurate forecasting models are forecasting 6 to 7% inflation for as far as they can see for the next few years. So what this tells us is our next major cyclical low that would be a coincident, when they share the same low, the 18-month and the 9-month will be in March of next year. And before you look at that, I mean, here the market topped right in January, and we're talking about 13 months out for the final low. But look here in this bear in 2007 topped in October of 2007 and didn't bottom until March of 2009. That's not really too far off from our dates. So and all these cycles divide in half. In October, which is always our famous bad month, we will have basically a 20-week cycle low, which is half of a 40-week. So we'll have some downward pressure there. But I don't know where this is going to land. It doesn't tell us where it's going to land. But, kind of a rule of thumb, you can figure about double this into these lows. And you can see what it's like here. And the other thing to notice is once you do the first wave down and the second wave up, and that usually finds resistance at the 21 month line, which is the mean. So up in this range where we are right now. In fact, it even got above it for a little bit, and that would really fool people. This third wave down, as per usual, is the nastiest one. So use your imagination, think what could cause that, but that's something we're potentially facing in our future. So as I said in the title of this video, enjoy the long vacation right now because the Great Reset will soon cut it to a big short position. right? So keep that in mind. So let's segue then to the daily chart and get into more of what we were expecting in the current picture. So remember, this morning's video is X marked the spot, right? So let me just remind you again, here are all the June levels. So here's the June high, here's the June low, and these are the midpoints, which is kind of where we're at now. And so, you know, a definitive break above this level here would probably counsel that maybe something, you know, bigger is going on. Maybe it is a turnaround. And this is the bottom of a cyclical bear, and we're either going to go up to new highs or possibly a trading range. Hard to believe at this moment, but it always is. So keep that in mind. So I'm keeping those levels in the back of my mind. Obviously, if we break below the 36.39 June low, that would be problematic. And again, just reminding you that we did move through this air pocket here, right? So the top of that air pocket's about 40.50 and the bottom is about 36.75. So, you know, just keep that in mind. You know, it's good to know where you're at as far as the price action goes. And, you know, honestly, from this low here, I mean, so far so good. We've had some decent breadth on the rally. The volume could be a little better, but it's not bad. And even today, we closed at the top of the bar. We had a nice bar up that we broke through. We sort of paused yesterday, kind of balanced out, and then we took a nice move higher. So this move here is through that air pocket, which is why there wasn't a lot of resistance. But we will be encountering some things as we go along here. So let's make sure. So you've got that June range you want to keep in the back of your mind. And then let's go ahead and put in some of the other support and resistance levels. Now, one thing I did draw in here was that, you know, we are forming a channel here. So I think it's good to have that on your chart because we will encounter resistance here. So, you know, we talked about that 40.50 to 40.70 level. So back there on the monthly profile, we've got 40.70 and 40.81. So that's all in this range here. Actually, I was going to do this later, but I'll just put it up here now. So there's X marks the spot, right? This is where those, you know, profile resistances come in. Now, notice how that's also the top of this channel, this up channel that the market has formed. Let's do a quick Fibonacci projection. Your first wave up and down is normally called your seed wave. And what you want to do is just take a quick projection from that wave to give you your first target. So you take this whole loop here, so from the bottom to the top to the bottom, and project it up. And the 1 is your initial target projection. And that, again, is where X marks the spot. So now you've got the top of this channel. You've got the first Fibonacci target projection. The June stuff doesn't really help at that point. Now, let's look at our expected moves, our little sandbox for the week and for tomorrow. Here's where we settled at the close today. And like I said, we gapped down in futures and it hasn't gone anywhere yet at this writing. So there's our weekly expected move. And note that, let me turn the colors off just to make it a little easier to read. Note that we are currently outside that move, okay? And a lot of that was because of that order imbalance at the end of the day. More than likely tomorrow, because the dealers lose a lot of money if we close outside this range. So they're going to probably try to bring it back into that range tomorrow, which gives us a little more time to think. I think it's a little bit risky. In fact, we took our long positions off. We did great in the futures room today. We had only 15 points, and if I didn't have a dental appointment, we probably would have made a lot more. But I did go ahead and take we had a 40% position in August SPY calls, and I went ahead and took that off at around 39.80 because, I just don't want to ride this thing back into range. And I am a little nervous about this area, and I'll show you why in a minute. Now, for tomorrow, here's our expected move range for the day. And again, you got with the weekly expected move and being above it, I don't give this, we might go up there temporarily, but I would just note again, the top of the expected move is right where X marks the spot. So if we do go up a little bit in the morning before we come back down and retest, and it's not uncommon to retest a breakout like this, I just want you to note again, X marks the spot, right? So keep those in the back of your mind. And let me take you through something else real quick. Now, as most of you know, I'm not a huge Elliott wave person, but it doesn't hurt to look at them because rallies usually and declines usually occur in 3 stages. Now, this is a Wilshire 5000, but it's very similar to the S&P. So this was the top of the market. We came down and we did a 1, 2, 3, 4, 5. And that was the first wave down. And then we did a 2 up. And now we've done a 1, 2. And some people believe that this is a small 1, 2. And that, we're not going to go too much farther. We're actually going to hit that 3 down like we saw there in, the 2007, 2009 bear. It's possible, who knows? I don't want to exclude it as a possibility, so we'll keep it on the table, and I want you to just see that. But in my view, I still look at this entire decline as a 1, and I think we're in a 2. And that's why I don't trade Elliott wave. I have an awareness of it. But as I've said many times, it's not reliable enough to trade unless you're trading in your rearview mirror. But again, just noting it for the record so you have an awareness of that. And I guess one of the reasons I wanted to point that out, let me go to the S&P, just more of a little breakdown, because I think the important thing to see is that this, what we're in right now could actually be part of an expanded flat correction, which is a 5-3-5 pattern. And if so, then this would support this being more of a minor 2 wave, and that we might have that dastardly 3 wave down to come, and sooner rather than later. And with the Fed meeting lining up for next week, you could see a catalyst there. So the main reason I wanted you to see the Elliott argument is that this could actually still be a bear flag. And, I want to keep that. I actually think that's quite a likely scenario, but I want you to keep that in the back of your mind. And if it is, again, X marks the spot, right? But it gets better. It gets even better. Now let's go down to our moving averages. So what we want to do now, I do this on my day trading charts too, but we want to bring down the upper time frame moving averages that are important, and we want to see them on our daily chart because that's going to help us, translate things. And you want to do the same thing on a 5-minute chart. Excuse me. So let's look at this. First of all, there's our Navigator Algo trigger line, and that's certainly something we would not stay in any trades if we violated that. But that's more the current time frame. Now, here are those 2 very important moving averages from the monthly chart. This is the 21, and this is the 5. And note that they're both pointing down. You can actually see the cross occurring here, or it may be a kiss. But once again, X marks the spot. So let's bring our weekly averages down. And there's our weekly 21. That's our mean. Once again, resistance. And once again, X marks the spot. Now the weekly 5 EMA, which is sitting down here at the algo trigger, these should provide support. So it's kind of just the opposite. And then finally, let's bring down the current time frame moving averages. So we've got the daily 89 sitting there, which is a key moving average. In fact, I use the 89 as my bull bear threshold in any time frame. You know, and generally speaking, we're below it, I'm going to take short trades. We're above it, I'll take long trades, other than at an extreme. And you can see the 50 and the 5 and the 21 dailies down here, all providing support. So once again, X marks the spot. Look at everything coming in there and coinciding, and that would include a trend line, right? We've got a supply line coming in from these two highs here, which also sits in that range. So what does that all mean? And I think what it means is this could very well be a bear flag that's going to top out right here and probably coincident with the Fed meeting, and then we roll over again. Or, and this is something I try to beat through traders' heads, okay? You know, like a lot of traders would look at this and go, oh, wow, you know, this is, I'm going to sell here. You know, this thing's not going to make it. And that might be true, but it could also make it. And if it does, then, you know, when what should happen doesn't, right? The WWHSD. When what should happen doesn't means that if you're encountering an area like this that should provide resistance and the market should turn down here, and it doesn't, that is an indicator in and of itself. And you want to always remember that when you're using these indicators and something fails for some reason, always consider the opposite side of the trade that you were intending to take. Now, one final thing to point out is that there's an incredible amount of outstanding options and options gamma sitting at 4,000. I might be able to step down. Let me step down to this chart, see if I've got it up here. So you can see it in a lower time frame. The I don't have it set up here yet, do I? I don't think so. But anyway, just trust me. The options gamma and resistance sitting here at 4,000 is formidable. So kind of, you know, at the beginning of the week, I said 4,000 for major resistance, 3,900. You're kind of in the fair range, and 3,800 is where the floor drops out. And I don't think my forecast has changed at all. So add it all up, right? You've got all those moving averages. You've got a supply line. You've got the top of this channel or potential, you know, expanded flat pattern. You've got the top of the expected move. You know, you've got that Fibonacci projection, all of that sitting here that is going to be a formidable you know what? It's getting late. formidable obstacle. It's going to be tough resistance to get through. But if we get through it, certainly bolsters the bullish case, you know, at least in the short term. So I think, you know, just one other thing. Let's go up and look at the algos, and then I think we can wrap this up. And obviously a key part of what we do here is this algorithm that I designed. And it is pretty extraordinary. So let me get this down here for you. And we're going to look at a couple of things that are kind of interesting. First thing you might want to know is, by the way, these are what are called fire lines. They're just Fibonacci projections. And these are projections that I made back in 2009. And these haven't changed from that point. And I want you to just see how they frame the market and provide support and resistance along the way. Again, another little kind of shortcut roadmap. And we're at a mogul right now, which isn't a super significant level. And our next major level is 4,100. So what do you say? X marks the spot. The fire line is the most important line, and it will act as support and resistance depending on the direction you're coming from. So there's another thing that you can mark the X spot with. But what I really wanted to show you here is that we're firing long from a volatility squeeze. And you can see the Bollinger Bands here inside the K band. And again, that's a very bullish sign, and it's usually good for 6 or 7 bars. So I still think we have a few more updates. I really do think we're going to hit that target, if not tomorrow, certainly by early next week. And it is kind of interesting that for once we're basically rallying into the Fed meeting. So let me just wrap it up here by showing you the algo, and the daily algo remains in these buy signals, which are also true on the hour and 2-hour charts. And I tend to use, especially when we're in a bear market and we're trying to go long, I'm definitely going to use those hourly charts as a more precise guide. I don't want to wait the length of time it takes a daily chart to generate a signal. But, our buy signal started in here on June 17th. We actually rode that rally. And we've been benefiting from this in the trading room. And we've ridden this rally. So the algo, and again, you can see the squeeze forming there as well. It's built into the algo. And of course, when you're in a squeeze, you're coming out of a kill zone. Trend stays bullish. The strength of this trend is not what it could be. That is for sure. I mean, they're just kind of feeling your way through it today. The market was moving up through that pocket. That was nice and everything, but it wasn't exactly moving like a rocket. I might have expected it to be a little stronger. So there's definitely still a lot of hesitancy in this market, and there's still going to be plenty of people that sell this rally, whether they live to regret it or not, I don't know. So let's also take a look at the 15-minute algo, because that's what we use as our anchor chart in the day trading. And I think when we came in this morning, it was in a sell signal, and you can see that I'd mentioned that in the morning notes. So we had a little move down to the bottom of the channel, and then we had 2 rallies. Nailed this one for sure, but then I had to go to the dentist, and I missed that, but that's life, right? Still got to do a few things. I think the other thing interesting, this line shows whether the S&P 500 is outperforming the NASDAQ 100. And generally speaking, you want the NASDAQ 100 to lead. And you can see from even right in here, the S&P started underperforming the NASDAQ 100. But today, it just wasn't doing it. And that can be an early warning sign that we hit, X marks the spot and perhaps reverse violently. So let me see if I can wrap this up in just a few words. We're coming off the 9-month cycle low on June 17th. Going according to plan. We've got some targets. X marks the spot, which is really around, we'd say maybe the 40-70 area is going to be formidable resistance, and probably even up a little higher, probably more like to 41, anywhere from 40.80 to 41.80. I know that's a wide range, but you can also note that this is really where, if you look at these lows across here, right, and you look at this high here, this is where the market originally broke down, right? So it is going to be resistance. Now, this could be part of a larger reversal pattern forming. We don't know yet, but I think here and here are going to be 2 formidable obstacles. And you can see that here. There's your 41.80. It's the next peak in this auction that began, I believe this one began in March. Look on the weekly auction here. Hold on just a second. Okay, yeah. So this is this auction, this whole round here began in March of 21 and ended in June of 21. So that gives you kind of a sense of what created a lot of this price volume. And then, of course, we added some to it on the way down. And, of course, this is where that capitulation occurred. This is a very strong capitulation in the market, so there wasn't a lot of volume in here because it just kind of crashed. So, again, that's why we can move through this area rather quickly, because there's not any overhead supply of people that made bad trades. So anyway, let's leave it there. Let's see if we can get to this 40.80 target, maybe a little more. Let's see how the market acts there. In the meantime, be aware of the weekly expected move high that will act as a magnet to draw the market back in. But again, so far so good. These have been very profitable runs for us. And that's why I encourage you, again, go over the website, get some information on what we offer. The trading room has been awesome, and we've made money every day. So not that the past guarantees the future, it never does, but if we continue on the same path, it's pretty good. And you'll learn a lot. Yeah, I mean, you will learn a lot. Like I said, I've been doing this for 35 years as a professional. I ran and owned my own hedge funds, my own mutual funds. I had my own bank, my own trust company. I've been doing this a long, long time. I retired very young, and I have mostly traded my own capital over the last 25, 30 years. So I'm always happy to share this information. It's a lot of fun for me, and hopefully you'll learn a lot too. So once again, if you like this video, please give us a like. Please sign up for the notifications and sign up for the channel. Hope you've enjoyed this, and you can always email me at info@blueprinttrading.com with questions, and we'll leave it there. Have a great morning and a great day trading, and I'll be back again on Sunday night. Bye-bye.